right. Good morning, everybody. Looks like we're live. Heading to actually wash my car because the car is pretty dirty. I'm not gonna go into details, but what happened was somebody drove the car through a big pile of dirt and realized it was not a actual road, and then doing the busted U-turn to get out of it. Threw up a bunch of dust, and then now the car is covered with dust and everything, so got to get it cleaned. Looks like the weather's going to be pretty great in Maryland today. It's going to be about 90 degrees, so man, wish I was back in California for weather like this so that I can enjoy the weather. So just wanted to kind of bring you along with me and give you some updates on what the market is, how everything is going. Haven't done a few videos in a while. I've been a little bit busy with personal life, kids getting sick and all that stuff. I don't know about you guys, but hope you guys are all staying safe and healthy and ready to enjoy the summer, especially it's the first full summer post-COVID. So I think it's going to be nice just to get out and enjoy the weather. So current market update. So I think first thing is big news came out is that the yesterday Senate passed through for the debt ceiling, and so that's going to be really encouraging because the market, I mean it's been volatile for the past few weeks, and especially since kind of like the extreme slowdown that happened. I mean, we saw this coming. I don't know. I want to say at least 12 to 15 months ago, but we didn't know how long it was going to take, and it looks like it's taking a little bit longer than we thought. But with the debt ceiling bill being passed to increase the ceiling, what that's going to do is that's going to provide relief, and you're probably already seeing it in the market, but it's going to provide some relief into the rates. Now, is it going to bring it from the 7s to the low 6s and maybe even high 5s? I don't think so. It's not going to be that dramatic. But depending on who your lender is and who you're working with, it's going to be it's going to be in the high to mid 5s, and then maybe depending on who you work with, you could possibly get into the mid to low 6s, right? So that's encouraging because now you're getting out of the low 7s, high 6 categories and coming down to where I think we should have been and we were for the last few months. Now, regarding what we've been hearing in terms of the FHFA, the Federal Housing Financing Agency, so they're in charge of, and a lot of people don't know this, but they're in charge of creating guidelines for Fannie Mae and Freddie Mac, who then pushes it out to investors who are selling mortgage paper, mortgage notes to borrowers, right, to borrow money and stuff. So what they do, those guidelines, they are determining what the rate is going to be for the borrower at the end of the day based on a bunch of criterias. So it's going to be things like the amount of down payment, what your credit score is, potentially what your debt to income ratio is, if there's going to be an appraisal waiver or not, what type of home you are buying. Is it a primary home, a secondary vacation home? Is it an investment home? What type of construction type of your building is it? So is it a detached single family? Is it an attached townhome? Is it an attached condo? All those things, manufacturing, all that stuff. So based on a bunch of criterias, there's all these adjustments happening to the rate. So there's like a base rate, right, that they are saying that Fannie Mae and Freddie Mac can push out. But then after that, things are going to get added on or subtracted based on the person's situation, so the borrower's situation. So, if your credit score is low, that's why the rate goes up. If you're bringing less down payment, the rate goes up. If it's a condo, the rate goes up, and all these things, right? So that's why I always try to educate people, and I find it kind of interesting because there is a lack of information and education. I wouldn't say information. There's a lack of education on the home buyer borrower side because I think they feel like it's kind of like a credit card almost, because you're getting a rate that it must be pretty straightforward. Hey, my my neighbor or my friend bought a house with a said rate, so I must, we're kind of in the same income bracket or lifestyle, so I should be getting about the same rate as well. But that's not true, because you don't know how much money that person saved, how much money they put down. Did they get a gift money? We don't know, right? I mean, I don't think we're going to be asking them, hey, did you get gift funds? Did you get this? Did you get that? To increase their potential. And you don't even know what their credit score is. So I think that's where talking to a mortgage lender is important. But, so the Federal Housing Financing Agency determines the rate, and or not determines the rate, determines the adjustments to the rate. Determines the adjustments to the rate. And so based on those adjustments, that's what the borrower is going to get. So why am I sharing this? Well, because typically, traditionally it would have been said that, hey, you have to bring at least 20% down or more in order to get the lowest rate possible, in order to have your best position of getting the best rate, because that eventually is going to determine rate plus the mortgage term is going to determine your mortgage payment, right? But typically, now some people are watching this are going to say, hey, it's going to also be the loan product. I'll get to that. So typically that's the case. But what's been happening is, in recent updates to the guidelines by the Federal Housing Financing Agency, now what they're doing is they're making the adjustment to individuals, to borrowers who are bringing in less down payment. They're going to make it a less of an impact to the mortgage rate. So, for example, let's say if, as of today, if you were buying a home, and this is just hypothetical, but if you were buying a home and you're putting 20% down, and let's say the rate was 7.375%, then a person bringing 5% down, they have the opportunity to get a rate at 7%. That's a pretty dramatic difference. Now, is the payment going to be less than the individual putting 20% down? No, because the principal balance, the starting off loan amount, is going to be higher for the person that's bringing in 5%, but the rate will be lower, right? So that, plus there is some little bit of mortgage insurance depending on what your credit score is. But that's how they're making the adjustments to a person that's bringing in less down payment. Now, why are they doing that? It's because they want to encourage folks that have less cash for a down payment to be able to buy a home. That's what they're trying to do. So I think in that essence, it's good. They are shifting a little bit of, the, I guess, revenue they could have earned from a higher interest rate, because that's what an interest rate is making money off of lending out the money. They're shifting that revenue possibility from a person making less down payment down to folks that are going to be making a little bit more down payment, and then to individuals that are going to be buying either a second home or a vacation home, or an investment property. That's where a lot of the negative adjustments are going to be shifted to. Now, if you guys want, I can create a video breaking it down mathematically on a chart and just showing you. If you guys want to, comment below and I'll create a video for that. But that's one of the big things. Now, so for individuals who have 20% down, but they still want the lowest rate. They're like, hey, I think this is unfair. How can I still get the lowest rate with 20% down? So one kind of like hack you can do is you can put 5% down, right? I don't know if you'll be able to win in the current market, but that's where, I'll get to that after this comment. But you can put 5% down, and then after your loan closes, after settlement, and then wait a couple of months, what you can do is you can call your mortgage servicing company. It could be the lender, it could be a different company. It's not atypical, right? So actually it is typical. So that the mortgage company and the servicing company could be different, but you can call the servicing company and then ask them, say, hey, do you guys allow recasting? If they do, what you can do is you can say, okay, I'm going to put the remaining 15%, or however much the cost, the actual amount is. You put it down and you call your mortgage servicing company and say, I want to recast my loan. And what that's going to do is after you make the payment for the remaining 15%, you're going to be able to recast the remaining loan balance that you have, right? So remaining loan balance, you're going to be able to recast it for the remaining term of your mortgage. So let's say you waited 2 months. That means for a 30-year fix, that's 360 months. You waited 2 months, which is 358 months. That's left. You're going to take the remaining balance after that big whop of principal balance payment that you just made, and you're going to recast that leftover balance across 358 months. That means what it's going to do is instantly it's going to reduce your mortgage payment down to what it needs to be. Plus, you're going to be still holding on to that lower rate. Now, in the current market, is it worth doing all of that? I personally don't think so, because if you read the experts, articles from experts out there, we're expecting I think we're already in a recession, but they're expecting a recession to happen. And if it does, typically what happens is mortgage rates drop with a recession, because when the economy is not doing well, typically what's happening is the financial markets on Wall Street are going to go and invest their money into more conservative areas, which is like mortgage bonds. So they're going to be investing into mortgage bonds, which is going to increase the mortgage bond price, which means it's going to decrease the rate that consumers are going to be borrowing at. So that's what we're expecting it to happen. So if that's the case, going through all this recast, because it does cost money, you got to ask your servicer, but I'm going to say it's going to cost anywhere from a couple $100 to $500 to recast it. So, recasting it for when you know that you're going to be probably refinancing out of that rate anyways, I don't think it's worth it. Now, let's say you're watching this video and it's already where the rates are in the 4s. Now, yeah, I think it's worth recasting, because now I don't think it's going to get back into the 3s. Highly doubt it, unless we have another global pandemic and everybody's going into conservative bonds rather than investing into the financial markets, right? So that's one thing. Another thing is, so let's say you might be a realtor or a savvy home buyer, and you're thinking, okay, well, if I show that I'm going to be putting 5% down, I'll probably decrease my chances of winning the bid for the offer on the home. And you are right. So what you could do is, if you have 20% down or plus, you can disclose that you're going to be putting that X amount of money down for the home, and then during the mortgage process you can make adjustments to your mortgage scenario, so you can decrease the down payment amount. Now, one big caveat to that is, if you are working with a savvy lender who is running what we call a pre-underwriting process and running your application through Fannie Mae or Freddie Mac to see if you're getting an appraisal waiver or not. If they're already doing it and you got an appraisal waiver, which typically happens when the down payment is greater than 20%, you'll probably lose that appraisal waiver. And if you are waiving appraisal as part of your offer, then you got to make sure you are coordinating and disclosing this information, that you want to decrease your down payment to get the lower rate with your lender, as well as with your real estate agent, to make sure that if the appraisal waiver is still intact. And I'm going to most likely guess it's not, but you got to coordinate with them so that you understand your full strategy. Because if part of your strategy is to waive appraisal and you're going to lose that, then you might lose the deal, right? The seller might back out. So just keep that in mind. Now, last thing about current market update is it's still pretty crazy. I've spoken to several of my realtor partners, and one thing that they said is it's almost exactly like last year in terms of when you list a home or the bidding wars, but it's just less inventory. So that means that there's almost the same amount of buyers still bidding over asking price, but there's less homes. So one listing agent said she received 80 offers. 80 offers. Isn't that crazy? I mean, it's June of 2023 and she received 80 offers. And then there are some, they're reviewing 18 offers and going back and forth with, the buying agents and all that stuff. Still minimum in certain pockets of the country, it's minimum that you have to put at least 10% over asking price in order to win on the bidding war. If not, then don't even bother because it's going to be pretty rare. I mean, you can. I've seen it. I have a client that recently won below list price, but it's because it's a motivated seller, and so they want to do that. But that's some of the things that you kind of have to work with your agent to make sure. Is it possible? And do they have the stamina and endurance? You as a buyer, as well as the buying agent, your representative, that they have the stamina to continually write offers and submit it and all that stuff. All right, so hope that was helpful. I'm sure there's so many things that I got to cover, but I'm trying to do that while I'm driving to the car wash, and I just got here. So hope that was helpful. So. If you have any questions, feel free to comment below and I'll try to get back to it as soon as I can. All right. Thanks, everybody. Have a great day.